Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
Yeah, it is great to be back here. We've got a lot to get through today.
We really do. So it is Friday, February 20, 2026. And I have to say, just looking at the terminal this morning, the market feels like it has a split personality right now. We're seeing a very distinct split screen in the global economy.
Oh, absolutely. On the left side of the screen, you've got this very real, very immediate threat of kinetic warfare in the Middle East. It's tense, it's volatile, and it's dominating the news cycle.
Right. And then on the right side of the screen?
On the right side, you have the largest capital expenditure boom in history, just continuing in the tech sector, completely ignoring all that geopolitical noise.
Yeah, it's a classic case of short-term geopolitical shock versus long-term structural growth.
Hmm.
And honestly, I think it's giving the markets, and probably a lot of you listening, a bit of whiplash. I mean, you have defense and energy stocks reacting to these war drums.
While the Nasdaq is trying to figure out if it cares more about a potential conflict or, the next generation of AI models.
Exactly. And that friction is what we're going to dive into today. Because one narrative is about the risk of destruction, and the other is about the massive cost of construction.
Yeah.
And both are going to hit your portfolio just at very different times.
Yeah, through very different mechanisms, yeah.
Right. So our mission today for this deep dive is to parse that signal from the noise. We've been reviewing a massive stack of recent financial reporting, military analyses, and some deep internal tech strategy data. We're going to break this down into two main tranches.
Sounds good. Where are we starting?
First, the ticking clock. Recent analysis shows the U.S. is reportedly ready to strike Iran, and President Trump has set a pretty hard deadline. We need to understand the specific economic mechanism of what happens to everyday Americans if that clock hits zero.
Right, because that is the immediate volatility play. We really need to talk about what ready actually means in market terms.
And second, we are pivoting to Microsoft. Because while the world is fixated on the Middle East, Microsoft is quietly, or maybe very loudly, deploying $50 billion into the global south and fundamentally changing how they work with OpenAI.
Which is a huge signal for where the next decade of growth is coming from. I am really looking forward to unpacking that because the headline number is massive, but the strategy underneath is even more interesting.
And I'll play the voice of the skeptical investor today. Because I see these headlines, and I know I'm supposed to be worried, but I need to know if this is just noise or if I need to actually move my capital. You're the data wizard, so you're going to help me look under the hood.
It's a deal. And just as always, a quick disclaimer for everyone. We are discussing high-stakes politics today, specifically U.S.-Iran relations and military maneuvers. We are citing recent reporting, but we are analyzing this strictly through an economic lens. We aren't taking sides here. We're just tracking the money.
Perfect. Let's get into it. Topic 1, the ticking clock. Looking at the latest data, the headline is blunt. The U.S. military is ready to attack, but the go order is basically sitting on the president's desk. What are the specifics we're seeing here?
Well, the timeline is the critical data point. According to recent analysis, as of yesterday, February 19th, President Trump has effectively set a 10 to 15-day deadline for a nuclear agreement. And the rhetoric is explicitly binary. Get a deal done or face severe consequences.
Okay, so 10 to 15 days, that puts us roughly in early March. But then I'm looking at other military reporting indicating that the assets, the carriers, the strike groups, they could be ready to launch as early as this weekend.
Yep.
So February 21st or 22nd. Which is it? Are we waiting 2 hints or are we looking at fireworks tomorrow?
This is where you have to separate capability from intent. Think of this like a high-stakes poker game, specifically the concept of leverage.
Okay, walk me through that. I'm at the poker table.
Right, so in poker, you might shove a massive stack of chips right into the center of the table. That is your carrier strike group. You are demonstrating absolute capability to end the hand right there. But pushing the chips in doesn't mean you actually want a showdown. You're trying to force the other player, in this case Tehran, to fold.
Because you want the leverage of the threat without the actual cost of the execution.
Precisely. So the reporting about being ready this weekend, that's the chips hitting the felt. It's the visual confirmation that the threat is real. It escalates the psychological pressure.
Because if the U.S. wasn't ready to strike for another month, the 10-day deadline would just be toothless.
Exactly. By confirming capability now, the deadline becomes a very real wall. It shifts the risk profile from weeks away to days away.
Okay, so let's assume for a second the market is taking this very seriously.
Yeah.
I'm sitting here with my 401k, maybe some broad index funds. Why does a 10-day deadline matter to me specifically? Is this just a bad week for the news, or is this a tangible market event?
It is a major volatility event. Markets absolutely despise uncertainty. When you have a defined window of high risk, like this 10-day period, liquidity tends to dry up in riskier assets and move toward what we call safe havens.
We hear that term a lot on financial networks. Safe haven. Usually people immediately think of gold. Is that still the playbook in 2026?
It is, but with some nuances. Gold is the classic hedge against geopolitical chaos. It's the ultimate fear trade. But you also have to look closely at the US dollar and oil.
Well, oil seems pretty obvious given the geography of the Middle East.
It is. It's like buying storm windows before a hurricane hits. The market starts pricing in a risk premium on every barrel of oil. You're paying extra right now because you're afraid the supply might get cut off later. But the dollar is the really interesting one here.
Why does the dollar go up? If the U.S. is the one potentially getting into a conflict, wouldn't the value of the dollar go down?
You would logically think so, but historically, the exact opposite happens. In times of extreme global stress, capital tends to flow into the U.S. simply because it is the deepest, most liquid market in the world. Investors want cash, and the U.S. dollar is the ultimate cash.
So we might see a scenario where the U.S. is actively engaging in conflict, yet the dollar actually strengthens against other currencies.
Right, and seeing a rally in the dollar and gold simultaneously is historically kind of rare, but that's the prime signal of true geopolitical stress. But I want to bring in a point from some recent strategic analysis because it raises a crucial distinction. It takes this beyond just the price of oil going up. They're asking, if a strike happens, is it a one and done or is it a campaign?
That feels like the vital question. Because a one and done sounds like, a targeted airstrike on a facility, in and out.
Right, a punitive strike. If that happens, oil spikes for 48 hours, the trading algorithms panic sell, and then things usually settle down once the smoke clears. It's a blip. The market absorbs it and moves on.
But a campaign, that implies a sustained, ongoing conflict.
A campaign means weeks of active engagement. And this is where the economic damage gets sticky for the everyday person. It's not just about the price of crude oil. It's about the mechanisms of global trade, specifically shipping insurance.
Shipping insurance.
Oh.
Okay, that sounds incredibly boring, but I have a feeling you're going to tell me it's expensive.
It is incredibly boring and incredibly important. Every ship that moves goods, whether it's oil, sneakers, or car parts, needs insurance. If the Persian Gulf becomes an active war zone for weeks, the insurance premiums for those ships don't just go up a little bit, they skyrocket.
Or I assume the ships just stop going there entirely.
Correct. They divert all the way around Africa, which adds 10 days to the journey and massive fuel costs.
Which creates a huge bottleneck.
Exactly. And that cost, the insurance, the fuel, the delay, it doesn't just get absorbed by the shipping companies, it gets passed on to the retailer and then directly to you at the store. So a campaign scenario isn't just a gas pump problem, it's an everything problem. The cost of materials, food, consumer goods, Amazon deliveries, it all creeps up.
And that sounds like the big I word, inflation.
That is the real fear for the Federal Reserve. They've spent years fighting inflation. A sustained conflict is a massive supply shock that could reignite inflation almost overnight. That's exactly why the market is holding its breath right now.
So investors are basically in a holding pattern. We're watching the poker players. If the U.S. folds or Iran folds, the risk premium evaporates and stocks probably rally. If the chips go in, we have a global supply shock.
That's the binary outcome we are staring at for the next 2 weeks. It is purely a waiting game.
All right, let's pivot. Because while the government is managing a crisis of potential destruction in the Middle East, the tech sector is managing a crisis of expansion. We really need to talk about Microsoft.
This is the other side of the coin today, the construction side.
The number jumping off the page in the recent data is $50 billion. This comes from Brad Smith, Microsoft's president, speaking at the India AI Impact Summit. They're on pace to invest $50 billion into AI infrastructure in the Global South by 2030.
It's a staggering sum of money. And to be clear, when they say Global South, they're talking about India, Southeast Asia, Africa, and parts of Latin America.
Now, the cynic in me, or maybe just the prudent investor, asks why. Why dump $50 billion into developing markets when the heavy hitters and the big money are in the U.S. and Europe? Is this Microsoft running some kind of charity operation?
Microsoft is definitely not a charity. They have a fiduciary duty to their shareholders. This is pure cold strategy. It's about a concept we call market saturation versus finding a blue ocean.
Explain that in the context of AI for us.
Think about the US and Western Europe. Everyone has a smartphone. Everyone has high-speed internet. Every major corporation is already on the cloud, either Azure, AWS, or Google. The market is very crowded. It's a dogfight for every single inch of market share.
The pie is already carved up. You basically have to steal customers from someone else to grow.
Exactly. But the global south, that's where the next billion users are. It's like a car company looking at a town with no roads. If you want to sell cars there, you can't just ship the cars. You have to pave the roads first.
I see. So Microsoft isn't just building data centers to be nice. They are building the digital roads, the actual cloud infrastructure, so that for the next 20 years, the economies of India and Africa run on Microsoft pavement.
Precisely. If you build the foundation, you own the building. Brad Smith also emphasized skills and training in his talk. That's the exact same logic. You need to teach people how to drive the cars you want to sell. By training millions of people in these regions on Microsoft AI tools, they are locking in a generational customer base.
It's the ultimate long game. We're sitting here worrying about oil prices next week, and they're worrying about cloud contracts in 2035.
That's the difference between trading and investing. They are betting on the sovereign needs of these countries to have their own AI infrastructure.
But there was another nugget in this story that I think is even more significant for the immediate tech landscape. It's about the relationship between Microsoft and OpenAI.
Yes. The ultimate power couple of AI.
Right, because for a while it seemed like they were totally inseparable. Microsoft puts in billions. OpenAI provides the magic models. But Brad Smith was surprisingly candid recently. He admitted the partnership is less exclusive than it used to be. And the data shows Microsoft is now actively partnering with competitors like Anthropic, the makers of Claude, and putting them on the Azure platform.
This is a huge shift. It's a fundamental change in the AI business model.
It kind of feels like, okay, imagine a strictly monogamous marriage. And suddenly one partner says, hey, I think we should start seeing other people.
That is honestly the perfect analogy. It has moved from a monogamous marriage to an open marketplace.
But why do that? I thought betting on ChatGPT was the winning lottery ticket. Why would Microsoft dilute that focus?
Because of risk management. Microsoft realized that betting their entire future on one horse, OpenAI, was a massive concentration risk. What if OpenAI hits a wall? What if the leadership leaves? What if a different model from Anthropic or Google suddenly becomes the industry standard?
So instead of betting on the horse, they decided they just want to own the racetrack.
Exactly. Azure is the racetrack. If Microsoft owns the cloud infrastructure, it doesn't matter which horse wins. OpenAI, Anthropic, Mistral, it doesn't matter. As long as they are all running on Microsoft servers, Microsoft gets paid.
That's the infrastructure play.
It is. And it goes both ways, by the way. OpenAI is seeing other people, too. They're talking to Oracle. They're talking to SoftBank.
Wait, why? Is Microsoft's wallet not deep enough? We just talked about them spending $50 billion.
It's not just about the money. It's about power. Computing power. The energy and compute needs for the next generation of these AI models are so astronomical that even Microsoft might not be able to feed the beast alone. OpenAI needs more compute capacity than any single company can easily provide.
That is mind-boggling. The scale of this is just hard to wrap your head around. So we are officially moving to a multi-model world.
Correct. From an enterprise perspective, think of the big Fortune 500 companies. They don't want to be locked into just ChatGPT. They want a menu. They might want one AI for coding, another for creative writing, and a totally different one for data analysis. Microsoft knows they have to offer the whole menu, not just the daily special.
So for the everyday listener trying to understand this, the takeaway isn't just go buy OpenAI. It's look at who owns the plumbing.
Always look at the plumbing. There's that old investing adage from the gold rush. Everyone ran to California to dig for gold. Some got rich, but most went broke. Do you know who made the consistent fortune?
The guy selling the shovels.
The guy selling the shovels, the pickaxes, and the denim jeans. Levi Strauss didn't dig, he supplied. In this AI revolution, the large language models, ChatGPT, Claude, those are the gold mines. They might be empty, they might be rich, but the cloud platforms, Azure, AWS, they're the ones selling the shovels.
And by opening up their platform to Anthropic and others, Microsoft is ensuring they sell shovels to absolutely every miner, not just their favorite partner.
Exactly. They win either way. It de-risks their business model significantly.
So let's try to synthesize this for everyone listening. We have two very different forces shaping the market this week. On one hand, the Middle East. High anxiety, binary risk, potentially highly inflationary.
a huge supply-side shock waiting to happen. If your portfolio is exposed to energy or logistics, you are watching that 10-day clock very, very closely.
And on the other hand, we have this massive structural capital expenditure from Microsoft, a huge bet on the global south, and a pivot to being the neutral infrastructure for all of AI.
Which tells you that despite the geopolitical fear, the biggest companies in the world are still betting aggressively on growth. They aren't hoarding cash, they're deploying it. That's a fundamentally bullish signal for the long term, even if the short term is scary.
It's a fascinating contrast. The government is managing borders, and tech is trying to erase them.
That's a really great way to put it.
Before we wrap up, I want to pull one final lesson from this. We've talked about war and we've talked about AI. Is there a connecting thread for the individual investor sitting at home?
I think there is, and it comes back to that word risk.
Go on.
We usually think of risk as bad things happening, a war, a market crash. But in modern portfolio theory, and clearly in Microsoft's strategy, the biggest actual risk is concentration.
Putting all your eggs in one basket.
Microsoft realized that relying solely on OpenAI was a massive concentration risk, so they diversified. The U.S. military realizes that relying on the Strait of Hormuz is a concentration risk for global energy.
So the lesson for you listening is to look at your own portfolio. Are you betting everything on one outcome?
Exactly. If a $3 trillion company isn't comfortable betting on just one AI model, you probably shouldn't be betting your retirement on just one sector or one asset class. In 2026, diversification isn't just a finance buzzword, it's a survival tactic.
That is a very powerful place to leave it. Whether it's navigating war drums or selecting tech stocks, having options is the only way to stay safe.
Stay liquid, stay diversified.
Well, that wraps up this deep dive into the forces shaping our world this week. We hope you feel a little less intimidated by the headlines and a little more prepared for whatever the next 10 days bring.
Keep watching the data.
Thank you so much for listening. Don't forget to subscribe and hit that like button.